Are we ready, Mark? You want to start this thing?
We are ready. Go for it.
All right. Well, here we go. We figured it out, I guess. We want to thank everybody for attending. We appreciate your participation and interest in these videos that we're doing. This is our, I think, third we've done this year. Mark and I did something similar to this back in February, and Mark did a solo venture of his on his own mid-year. The purpose of these webinars, or whatever you want to call them, informational videos, is to kind of answer your questions, maybe talk a little bit about what's on our thoughts, what we're thinking about, and what's happening in the markets, and just to kind of communicate with you, our clients, and people who are interested in our Scrum. So thank you for attending. Just so you know, if you have a question, there's a couple ways of doing this. You can either enter a question on the chat feature, which would be at the bottom of the Zoom screen. You just hit chat and type something in there. There's also a Q&A screen. You can also enter questions there. And we'll try to monitor those as the webinar goes on, and try to address those towards the end of our time. We plan on spending about an hour. Hopefully we'll have 10, 15 minutes for questions, and any other kind of wrap up things we might want to consider. We're going to cover a lot of topics today. It's probably going to be things we've already talked about previously, like inflation. You know, what do we think about the stock markets? Those things are still prevalent on our mind. You know, we continue to have volatility in the market since the beginning of the year. We'll share our thoughts on that as well. I think I wanted to start this with just kind of a recap of where we've been, and kind of a recap of what's happened this year. So we came off, and you know, if we go back to January of this year, we came off two very strong market years in 2020 and 2021. For instance, the S&P 500 in 2020 was up almost 18.5%. It's 18.4. In 2021, it was up 28.7%. You know, similarly, the Dow Jones was up very much. International stocks were up 18.28 in 2020 and up 11.78 in 2021. And remember, in 2020, that increase was coming off the you know, a terrible 45 days starting in February and ending in about mid to late March of that year, when COVID kind of hit us and shut down the whole economy. So far, we came off two very good years. So far this year, we've just been struggling. Been a lot of volatility with very little shelter. So year to date, and this is as of yesterday, these results. So it's fresh, hot off the presses. The S&P 500 is down just a little over 20%. Dow Jones is down 9%. There's some weird things going on there, depending on the Dow Jones has a little bit of a different weighting than the S&P 500. International stocks are down over 20%. The bonds themselves are down over 15%, almost 15.75, a little bit more than that. And the other thing that's been going on with us this year is inflation. Inflation. In September is 8.2. The number just came out this morning. It's down from what it was last month, down to 7.7, but it's still very high. And if we look back, 2021 into the year, inflation at 4.7. I mean, that's still pretty high from our normal experience. And then in 2023 is 1.23, which seems, you know, quite nice at that point. So that's kind of where the markets were at that time. But you know, if we go back to January, you know, we're just kind of in the midst of this COVID vaccine and booster area. I mean, if you can even remember that, that's what we were doing back then. But markets kind of started the new year declining, a lot of volatility. We might be able to kind of attribute that to profit taking or concerns about inflation and the Fed tightening or increasing interest rates. Could be part of the COVID hangover, Omicron surge, Russian posturing, but you know, we kind of just started the year just kind of in a decline. You know, in February, we had Russia invades Ukraine, kind of creates additional concern and volatility in the market continue to decline that month. And in March, we get an inflation report of 8.5% for the month of February, the previous month. And the Fed finally, after talking about this since December, decides to increase interest rates. So they take, a very kind of what I would call a little baby increase, tiny baby increase of 0.25%, and kind of what we've experienced so far this year. That seems kind of quaint, but that increase has been followed by 5 more increases so far, and we expect to see more coming in the months ahead. Somewhere along the line, transitory inflation became sticky inflation. In June, inflation peaked at 9.06, the highest in 40 years. Also in June, the January 6th committee hearings hit prime time, if you remember that. In July, the following month in July, the Fed came out after their meeting and talking about inflation and how they are dedicated to getting inflation in control. We could expect to see more increases in the interest rate at this 0.75 clip. And for the first time that month, they used the R word, recession. And since then, they haven't stopped shutting up about it, okay? And so as we move forward, October 30-year fixed rates hit an all-time high. They topped 7%, over 7%. That's the first time we've seen that kind of mortgage rate in 20 years. And coming in here just in the month of November, we got a Fed increase, another increase of 0.75% last week. The question now becomes, when will the Fed slow down the increases? Not when will they stop it, it's when will they start slowing it down, that is reducing the increases. And then just 2 days ago, we had elections. U.S. Senate is heading for a runoff. The control of the Senate is heading to a runoff. Control of the House is kind of unceremoniously flipping to the Republicans. The red wave didn't kind of crest as high as people had expected. So that's kind of where we are. It's kind of, I don't know if it's amazing is the right word, but it's kind of, when you look back, it seems like the COVID thing was an ancient history. We've just had so much going on here in the first 10-ish months of the year. But so that's where we are right now. And so we're going to kind of move on and talk about some of the things that I've just briefly mentioned in my kind of recap there. And we're going to kind of start off with some, what's going on this week, some current events. We just had elections. What effect might this have? Does it have an effect? And also maybe look a bit at some other kind of media type things with regard to that. So Mark, I'm going to flip it over to you, kind of kick this off and talk a little about this week's headlines. Mark, hello.
Okay, we're going to do a blooper reel because today's technology thing, which is all my fault, is absolutely hilarious. But okay, so I'm assuming everybody can hear me, everybody can see me. So as Dan said, the big news today was the inflation rate, which was projected to be 7.9. It was 8.2 last month, came in at 7.7, beat estimates. And the good news is our presentation's over because the market had the S&P 500's up 4%, the Nasdaq's up 6%. Our work is done. This bear market is over. And I'm saying that kind of tongue in cheek because yesterday the market was down huge because the big red wave didn't materialize. So the first thing I want to do is talk about the media and a little bit about the election. I'll talk about the election first. So leading up to the election, we had, quite a few conversations about, hey, Mark, hey, Dan, what do you think is going to happen if this happens or that happens? And so we did a little digging and really, there's some somewhat interesting correlations to who's in office versus, what stock market returns are. But at the end of the day, this is kind of the pattern here. You can see the red is when the Republicans had the House.
Mark, sorry, you need to share your screen, buddy.
Yes, I do, of course. Hold on.
That's why we do this. This is why we do this in pairs. So the other person can correct the other person.
That's right. That's right. Hold on just a
Because these
second.
things happen. Sorry.
Okay, let's see. Yeah. This is brilliant. Okay. Okay. How is that?
Yes. Now we got it.
Okay. So so the red is again when the Republicans held the House and the Senate. The blue is Democratic House and Senate, and then purple is mixed control. So this is going back to 1926. And as you can see, the real pattern here isn't who's in control, it's that stocks go up over the long term. Okay.
Stocks are in control.
If you want to go more granular, here's some more stats I pulled up. So of divided government. Okay, so basically divided government with a Democratic president, which is probably what we're going to end up as soon as the votes are eventually counted in Arizona. Hey, mom, who's in Arizona, and my sister who's in Arizona. What's up with the election? Count the votes. Just kidding. But you can see there's 14 years where that occurrence was or that occurred, and believe it or not, this S&P 500 stock returns were the best during that period. So you can see unified Republican 14.5, and ironically, unified Democrats exact same return. That's happened 34 years. So I think the correlation here, other than stocks go up in the long term, is 14 years, a sample size. I don't think it's big enough to draw a correlation. So,
right.
So that's that. Okay, so
and the correlation just means it's not a cause and effect kind of relationship. It's just like, hey, it just happens to be that the market goes up when certain parties are in control, that kind of thing. The cause and effect relationship is more unclear. It's just saying that these things happen at this particular time.
That's true. And business cycles are oftentimes much longer than 4-year presidencies. And so, people have said that the presidents oftentimes don't have as much control over the economy.
Right.
Although some of this inflation, pundits that's led to specific decisions by the government, but who knows? That's for another discussion. So, okay, so that's the elections. So let's talk about the media real quick, because I think in context, I think it's important. I love poking fun at the media because it is somewhat ridiculous. But we need to make sure that we're not in herding behavior. We like to follow the herd. I think that goes back to our caveman days. But the faith that we put into the media, I think, is typically it's unfounded. We need to be very careful. And let's keep in mind that the media their job is to exhibit fear and greed. They as I've mentioned,
to grab our attention. They want their eyeballs on it.
Grab our attention. They love hurricanes. They love stock market crashes. They love those types of things. So this is from CNN's Fear and Greed Index, and I think it's pretty classic. This was, I don't have the date on this, but I think it was probably last week. We were definitely in the fear stage. You can see 1 week ago it was extreme fear, so 18 and 18, which is very low. And flip forward today, 1 week, boom, hey, we're in the greed cycle. Okay, so this is constantly shifting. Are the fundamentals in the economy really shifting that much in short periods of time? I don't know, but they tend to love the fear greed pendulum.
Yeah.
Now
they don't. There's no consideration for, hey, everything's okay, everything's cool, just chill out. There's not a big news day. Take it easy. Everything's good.
Yep. Now that's one thing. So that's how they sell media advertising. The next thing is, in my opinion, is we put too much faith in them, because I clipped this from Yahoo Finance a couple of years ago. And this is who we're dealing with on some of these media outlets and resources. Okay, so US stocks edge higher as investors assess earnings. Same day, US stocks edged lower as investors assess earnings. And then the same day again, US stocks little changed as investors assess earnings. So
Now,
make up your mind.
Mark, is this the same day or is this the same screenshot?
This is the same screenshot. This is from the Yahoo
amazing.
Finance thing. So so anyway, I think enough said. So let's get into the meaty stuff, the charts that Mark loves. Okay, and I'm trying to go through them very quickly. So let's go into inflation. Okay.
Sure.
So as Dan mentioned, or we both mentioned, inflation came out. This chart's a little old. In August, it was 8.2. This core CPI. Specifically, this core PCE deflator is what the Fed is looking at. That's when they back out some, they have a complicated way of backing out business, inflation, and food and energy. You can see this is the trend line. We're way above it. Everybody knows that. And so basically what the Federal Reserve, I'll just call them the Fed, is their job right now to kill inflation. And they're not mincing words.
Right.
Powell said this last week. He says he wants to put us in a recession.
Right.
And hopefully it's a mild recession, but that's their only game plan to curb demand. Okay.
I think the mindset for them right now is the only way out is through. So, there's no going around, there's no circumventing, there's no, doing a fake. We just got to go through the pain to get to the gain, kind of thing.
Yep. And again, inflation, as you learn in school, it's supply and demand. Okay. Yeah. So the Fed they can control demand by making things very difficult on the consumer. They can't really control supply. Okay, but I'll show you some slides in just a second. So I thought I'd just take a second. Most people, including me until recently, don't really know exactly what's in the CPI index. I thought this was kind of interesting. So food and beverages, 14%, apparel, transportation, medical, and so on and so forth. But one thing I want to point out is housing. 42% of the CPI index, and they have a complicated way of figuring out what rents are, and also home ownership and such. So basically, when mortgage rates, so they increased rates, and they wanted mortgage rates to go up, and man, did they accomplish that. So mortgage rates hit 7%. As Dan said, I think it is a 20-year high. But also, I was checking. What's that?
Yeah, 20 years.
Yeah. I was also checking things like HELOCs, like home equity line of credit. Those are like 7.5% to 8.5% right now. So, so I think they're trying to slow housing without it falling off a cliff. And I think there's no doubt when HELOCs are 8.5% and I think it's going to be unlikely that people are going to be refinancing to pull money out to do a $500,000 remodel in their house or a couple $100,000 remodel because rates are 7% now. Yeah. Credit card interest rates are going up. Credit card balances, as I showed in my last webinar, are increasing. And so all these effects it takes a while to work through the system, but it is working through the system. And basically what's going to happen is the consumers are going to stop spending. But as most people have probably seen, the unemployment is still very low. And so everybody, employment is still very, very high. And so it's taking probably more time than they thought to cool the consumer. You were going to say, Dan?
Yeah, I was just going to say, I was at a conference last week. I went to a seminar about the housing in the U.S. current market right now. And it's no surprise that because of this interest rate so high, housing is slowing down. I know anecdotally, home prices in my house or home sales in my neighborhood, they're on the market longer. We're starting to see some lowering of prices and that kind of thing. That's mainly driven by this high interest rate. And everybody who's refinanced has refinanced. Like you said, there's no refinancing going on. So there's no cashing out, putting money in your bank to either remodel or buy a new car or anything like that. So this has a pretty big effect on probably spending going forward until interest rates come down, which could be quite a quite a ways out before we see interest rates back down to, even under 5 or under 4,
Yep.
Okay.
So back to the, so housing is 42% of CPI. So basically, we're starting to see some receding of inflation, although slow receding. And this is one reason it's coming down. U.S. national rents, which peaked at the end of last year, are only going up 5.8%. Now, granted, it's all relative because this is 5%, 5.8% increase over the big increase of 18%. Okay, so, but, I pulled this from today. It's kind of busy, but this kind of shows you what the CPI weightings are, and then what the number that was predicted today. So it came out, this inflation came out after this, but it's pretty close. And you can see the red spots are still the ones that are raging out of control. Fuel oil, as we've heard back east, is at a crisis level, and in Europe. Airlines, oh my gosh, 42% increase over last year. But here's the home ownership and rental. So this is what they call the owner's equivalent rent. So those are people that own houses. 6.8. Some of the rents, this predicted was 7.4, and so on and so forth. So as these things come down, some of these other things like food at home, groceries, is still pretty darn sticky. Restaurants, 8.7%. And food was like 13 or 14% of that index. So you got energy, food, and rent are what's driving those things. And some parts are still sticky and some parts are receding. In fact, here's an interesting chart or tweet that I thought was interesting. Over the last 12 months, 12 months ago, lumber had the price of lumber had doubled, and copper, and people were doing remodels, and the supplies through the remodels had doubled. But you can see lumber's receding, copper is receding, but what is still high is heating oil, some food products, and a lot of that, to be fair, is related to the troubles in Ukraine. And so that's alleviating that. Okay, so we talked about demand. Fed's trying to kill demand. Let's talk about the supply chain, which was a huge deal a year ago. And you don't need to pay attention to the chart, but here's where the supply chain, as measured by the Bank of New York, or the Federal Reserve Bank of New York, peaked in December of 21. But it's coming back down pretty significantly. And you can see October 21. So if we get down to this level right here, we're kind of back where we started from. Okay. And then I guess I need to get off Twitter a little bit, right? It's kind of
you might be the last person on there besides Elon.
My obsession. Yeah. So this is Liz Ann Saunders, who's the chief strategist at Schwab. And she said, simply remarkable, shipping rates for 40-foot containers from Shanghai to Los Angeles are below the long-term average. And those who live in Southern California, a year ago, we're looking out in the LA harbor and saw hundreds of ships. You're not seeing that anymore.
Yeah, there are very few anymore.
And so the supply chain is normalizing. The one part of the supply chain that is still struggling quite a bit are those the manufacturing in China. Apple just announced that they're having some manufacturing issues in China, and it's because China has their zero COVID policy. And but aside from that, things are easing up a little bit. Okay, so let's talk about interest rates.
Interest rates. Let's go.
And okay, so we've come a long way. Okay, so like a year ago, 2021, a 1-year treasury bond was paying 0.39%. 0.39%, the red bar here. This is as of last week or last month, recently, a 1-year treasury was paying 4.66%. And in fact, a couple of days ago, it was paying 4.8. And so, so that's good news. This, this increase, by the way, was the fastest and the fastest increase in 40 years, the fastest and largest increase in 40 years. And so, although that is terrible for bonds, that's what's causing the bond
prices to decline.
The prices declining, significant decline. And we'll show you later the worst year in I can't even tell you how long. The good news is there's a silver lining. So for those people who are savers and have money, they're now going to be able to invest really conservatively in like a one-year treasury and get almost 5%. And so so we think bonds will start producing much better returns in the near future.
Right.
By the way, here,
I was just to say the prices have stabilized, but you're earning a nice interest rate that we haven't seen in years and years and years and years, even on cash.
Yep. So here's the current expectations on rate increases. So, we get a question, when are they going to stop increasing rates? Okay. So we're currently just under 4%. The Fed funds rate, that you hear the Fed increasing, is just under 4%. So the market right now, the bond market is expecting it to peak at 5.1, and they're showing in July. I think last week or a couple of weeks ago, it was showing like April or May. Mm-hmm. And then what you see is it's gradually declining. Okay. So, so if they're right, then that's sometime mid next year, you should see a pause by the Fed, and at some point, possibly even a reversal. And so we'll just have to wait and see. But here's a chart, really busy chart. But basically the blue line here, this goes back, 1957. So 20 periods, 20 plus periods. The blue line this is right before the Fed did a pivot. And I'll define a pivot as, they're increasing rates and then they reverse. They either pause or they reverse. Okay. So you can see the blue line is interest rates. The red line is an inflation indicator. Now this guy does it's not straight inflation, but the rates are going to be very similar. Okay. This is how the Fed looks at inflation and how they compute inflation. It's not the CPI that's being reported this morning. They go through and exclude things, include things, and do some manipulation to it. But this is what they look at inflation. This is how they look at inflation, at least. And so what you'll see if you look at this for a while is there hasn't been one time in the last 20 plus pivots where the Fed did a pivot when inflation was still above the interest rate, current interest rate environment. And so this person from Hussman Funds, he's saying we're not even close. Right. Okay. Now, the inflation did come down this month. Okay. And interest rates are going to continue to go up. So once we get close to even, then we can start looking at maybe the Fed is going to start pausing, and then eventually might do a pivot where they start reducing rates. So we got a ways. We got a little ways. Another way to look at this is from our standpoint, or from an investor standpoint, is if you look at that red bar and it's more than what the interest rate is, that is more than interest you can earn on your money, you're more incentivized to go out and buy, because my money is losing value, so might as well go spend it right now. It's not until that blue bar gets even or above that red bar where I now say, oh, I should just hold on to my money because I can earn more interest and still buy the same amount of goods as I could yesterday. That's the other way of looking at that. That's very important. That might be the most important bit of information I think we talk about today. Yep. Personally. Okay. And then also to keep in perspective is this is what the market believes inflation is going to look like in the next, 3 years. So the red line is the 1 year looking ahead. And so this is a little bit dated. This is from like last week. They were saying it was going to peak at 5.4%, but 3 years out, they're expecting inflation to be back under 3%. So that's, I guess you could say inflation is transitory if you give it enough time, right? Yes. And so, and the market's always changing. So who knows if they're going to be right? Okay, so that's that's that about interest rates. Let's talk about employment. I'm kind of closing in on my part here, but the employment picture, see, the unfortunate part, and I'm sure most people have read about this or heard this, is the consumer is getting crushed by inflation. And so this is the real average hourly earnings have been going down for 19 consecutive months. Now, what this means is what do they make on an inflation adjusted basis? Okay, and so inflation is really crushing the worker, and so you have that, and also you assume if they are taking on debt and the interest rates are going up, their credit card interest rates going through the roof. Again, their line of credit, auto loans, I guess those are fixed, but anything that's a variable interest rate is also squeezing them. So expect some tougher times coming up here. So with that said, Dan, why don't you know exactly where we're headed with things, right? You're gonna.
I know,
right?
Absolutely right. Yeah, I got my crystal ball out.
Get your crystal ball out.
I put some uranium in it to fuel it up this morning, and
Okay, good.
I know exactly what's going to happen.
Okay.
So before we kind of go talk about the slide, just for a minute, what are we looking forward ahead to? And I think Mark would concur. If you don't chime in, from an investment market standpoint, expect more volatility. We're going to have some moments where assets are going to decline, they're going to increase, and move around quite a bit until we get inflation kind of under control, and probably until well after the Fed stops or starts easing interest rates. So the Fed's going to continue to increase interest rates. The question right now is, when are they going to slow down? Is it going to be the next time or a little after that? But they're not stopping, at least not anytime soon.
Yeah, and can I add something, Dan, real quick? So I think it's important to understand that markets look forward. They're forward looking, and so if that one chart I showed, if they think that rates are going to peak at 5% next year. Right. Then 1-year treasuries right now, the interest rate isn't 4%. They're predicting 4.8%. Okay, so markets front run, right. And stock market front runs even further out. Looks 9 months out. So what they're pricing things on right now is what it might look like, close to a year from now.
Right, absolutely. So this slide that's up here, I guess this is just to kind of raise. If there's we'll talk a little bit about like risk points that we see in the market or feel like we could be approaching. So right now, maybe the biggest risk the Fed is facing is this of the economy going to stagflation. And this is a very simple chart, kind of describes how stagflation works. So stagflation we haven't seen it since early 80s, so it's been a long time. But stagflation is when we have a market where economic growth is down, inflation is high, and unemployment is also high. There's a possibility we could kind of step into this kind of situation. We're not there yet, but this is one of the risk areas we want to keep an eye out for, just to kind of see where the economy might be. Because if we go into stagflation, certain assets do better and then other assets. And if you go to the next slide, Mark, we'll just show that. Mm-hmm. So in this slide, if you look at the kind of the bottom of that chart there, that's the stagflation scenario where we see, equities don't typically do very well in those kind of markets, but commodities do. What the Fed is really aiming for is that second row there called disinflation. Disinflation is basically where inflation is slowing down. It's not, prices are not going down, but the rate of increase is slowing down. So in that kind of market, equities do okay, US Treasuries do good. The only kind of areas you want to kind of minimize or be aware of is commodities don't do very well in those type of markets. So
disinflation, just to add, so that's kind of your soft landing where inflation's coming down, the economy is not tanking, and the jobs market, unemployment isn't ratcheting up sky high, and so we're probably heading towards, disinflation or stagflation. It's really difficult to tell right now.
Right. All right. So that's kind of the cautionary tale right there. Go to the next slide, Mark, and we'll talk about maybe some silver lining. So this slide here, I just want to demonstrate, even though we've had volatility this year, there are opportunities in these markets to make money. And this is going back to early, beginning of this year. The market's down 28% at its lowest, but we can see in this chart that there are times when the market rebounds, and this is the kind of, when I say expect volatility to continue, this is the kind of thing I expect us to see. We might be in a trading range. I don't really expect the market to surge down a great deal, though we could see some. But I expect more of a up and down kind of thing where we have some down markets, but there will be opportunities to make some money as well. And plus, as we said previously, interest rates are very high, so our cash and bonds is earning a more stable, steady interest than we had before. Go ahead.
Yeah, just to add one quick thing, that first chart that I kind of made fun of, of the market's over, now everything's up. The S&P at 500 being up 4%, that's a huge day. NASDAQ up 6%, that's today. But keep in mind that your biggest days in the stock market are during bear markets. And I mentioned this in my last, webinar, and I kind of showed you, 4 or 5 last bear markets. And so today's bounce, it could either be another bear market bounce, right, or bear trap, or it could be the end of it could be a bottoming process of the market, because when markets do finally reverse, it's pretty violent to the upside, violent in a good way. Yeah. So again, it's really impossible to know which one this is.
And even if this is a bottom, and we don't know if it is, you don't know when you're in these scenarios until you're way out of it anyways, but you could be at the bottom for a period of time as well. It's not like you get to the bottom and you immediately recover. Usually when they do recover, like Mark said, it's very extreme and very fast, but you don't know when it's going to happen. Anyways, yeah. Let's go to the next. Okay. Oh, we're going to talk about some bonds. Let's talk about the bonds. Mark, you want to comment on this a little bit? This is what bonds have been doing on the global standpoint.
Yeah. So this is a really difficult year. Not only stocks are going down, but bonds are going down. And we've done better. We've positioned portfolios, we think, better than the indexes by shorter term, higher quality stuff. But there's no hiding from what's happening in the bond market, and that's because of the fastest interest rate increases in 40 years. Okay, so as Dan said, the U.S. bond index is, and again, this is at the end of, I think, September, so it's slightly dated, was down 14.5%. And that's just your index, your safe bond index. And by the way, bonds are up huge today. So you got stocks up today, and then bonds are up in price today as well. So that's a really interesting day. But on a relative basis, I just want to show you, if you look at Japan, Germany, the UK, they're down, Germany is down like 14%, the UK is down 22%, Italy down 16%. But if you take into account, if you price the local currency and how weak it is, another trend that we didn't really talk about yet is the strength of the US dollar. And so right now, as many problems as we have in the US, we're still the best house on an ugly street, right? Or whatever the term is, okay? And so being in US dollars and US bonds is very attractive for the rest of the world. The problem is, is international emerging markets are getting hurt by the currency valuation. And so if you put it in dollar terms, it's a bloodbath in bonds.
It's been devastating bond markets in those areas.
Yeah. And then, and just to show you historically, we're going to have some good news coming up here, I think. So just hang with us, okay? Don't drop off. this is again the Bloomberg Bond Index, and you can see going back to 1976, the red here is the low point of the year, and then this part is where they finished up for the year. And if you look at 2022, it's the worst since 1976, and it could be even farther back than that, but they just didn't track the index. And so that's one of the difficult things that we're navigating as well.
Yeah, so a lot of times, even though there's decline in the bonds, they'd actually end up in the positive territory by the end of the year. And another thing, there was a chart where we had in our deck here that we decided not to use, but there was one that kind of demonstrated, like, right now we're currently in a market where stocks are down, the interest rates, bonds are down, inflation is up, and there's only a handful of times where that's happened in our history, going way back to even like the Great Depression. I think it was literally 5 other times that we've had that kind of scenario where stocks are down, commodities are down, bonds are down. That doesn't happen very often. Usually there's, usually one of those markets is up while the others might be down, but to have them all down at the same time, it's very unusual.
But that chart that Dan's talking about also shows the years after that, how the performance, and so things tend to bounce off those lows and do quite well in the years after that.
Yeah, very, very robust recoveries. All right.
Okay, so let's move to stocks. Take this away, Dan.
Yeah, go ahead. Okay, this is another way of kind of looking at the history of things. So what we have here is the blue is basically up markets as they come off bad markets. So the little red, the red there is basically areas where we had recessions or downturns in the market, and we can see that the recovery is very robust in all these kind of scenarios. Also, the down markets, the time we spend in down markets is way less than the time we spend in positive markets. That's the other kind of takeaway from this. So I know this year has been a really tough because we've had 10 months of volatility in the markets, and we haven't seen that length of time in a down market. I don't think until we got to go back to like the financial crisis, the Great Recession of 2008, where it lasted like 18 months, I think it was, if I'm remembering that correct. So, could we see continued volatility? Yes, we can. We could see some more down markets. Yes, we can. But just remember, I think our greatest investment tool that we have in our toolkit right now is patience. And that's why we allocate clients across, broad spectrum of assets to kind of help moderate risk. But it's to get through these periods so that we can kind of, even though we lose money, we're not losing as much as the rest of the market, but also to kind of persevere and get to the point where markets are going to recover, and they do recover, and they recover very robustly when they do.
Yep. Okay. All right.
So this is some valuation measures. Skip this one, Mark. I don't think this is better. Go to the little charts with the valuations. Here we go. This is, so we talked about this before. We talked about it in our February podcast, or not podcast, but our February webinar. And this is a clip that Mark took a picture of. That's why you see his face up there in the corner, where he talked about where valuations were at that time. And I think the important part to kind of focus on, maybe well, let's just look on the right-hand side. And if you look in the large value square there, you see the 15.8 versus the 13.7. So that's where the current PE ratio was. That's the price to earnings ratio. That's where it was at that time compared to where it is on the 20-year average. And so we can see basically what this is saying is that those areas of the market, those sectors of the market were overvalued. And if you look down below in the lower part, where you see 115, 135, anything above 100% would indicate that that sector of the market is overvalued. And at that time, everything was overvalued.
But things do get overvalued for long periods of time. And
right.
So those are against historic averages. Okay. So just to put this into more perspective, I took the data from February and then compared it to today. And a lot has happened since then.
Yeah. Just flip to the next one real quick. It's going to be the same thing.
Okay.
There we go. So this is where we are right now. These ratios, if you compare it to the one to the next, go to the next slide, Mark. So we can just kind of emphasize this a little bit. So the left side is where we were in February. The right side is where we are right now or in November. So we see that these, the current PE compared to the long-term PE, these have really changed a lot in the last, if I do my math right, 8, 9, 10 months, 9 months. Okay. And if we go to the next slide.
Yeah, and I'm not sure if you've mentioned this, but this is the historic average.
Yeah.
Okay.
20-year average.
Or 20-year average. Okay.
So the result of this is that on the left side, we've come from a period of where all these sectors were overvalued to where we're starting to see things coming into kind of, I guess, what we would call a normal valuation. And there's even certain markets which are looking really very attractive. Like, take for instance the small on the right hand side, the small growth at 66.7. Basically, I guess I would look at that. It basically looks like that sector is on a 30% discount. I mean, it's a 1/3 off sale. That's how I would interpret that. But if we look at this closely, the greatest value in the market is in the small and in the value column and the small row. Yeah, thanks, Mark, for emphasizing that. So that's where we're seeing the most value right now. We can, we might see more value going forward, but right now that's where we want to kind of focus the portfolio, and that's where we've been. And we've been tilting towards those areas of the market for a long time, because typically over time those areas of the market tend to have a little bit higher returns. So we do kind of tilt the portfolio in that direction, and we continue to tilt in that direction. So we kind of our expectations is sometime soon, hopefully, that those markets will recover, and those historically in a recovery, those areas of the market tend to lead the market anyways.
Yeah, and just to give some context, so like large value, I haven't checked in the last couple of days, but if the S&P 500 was down like 20%, large value is down 10 or less. So the last couple of years, the value, the small value, large value has outperformed, and likely that could more than likely continue. And so anyway.
And I guess another thing to say here is on the large growth, if you look at that box, even now, even though it's come down a lot, it's still probably a little bit overvalued. And, that's a lot of, the companies that have been leaders the last couple of years since COVID hit us. So, a lot of the big tech, a lot of the large super companies, that's still them. There's probably still a little bit overvalued. We could see those maybe come down a little bit more yet here in the near future.
That's a good point, Dan, because in previous webinars, I've shown you a slide of how top heavy the indexes were. Microsoft, Apple, Amazon, how much of the quote unquote market cap it was. And so they were like when the S&P 500 got to a low of down 25%, let's say, the average company in the S&P 500 was down over 35%. And so when the NASDAQ got down -30, the average company in the NASDAQ was down -50. So below the surface, you've seen some pretty rough waters. And I think so these, as Dan said, they got way overvalued. And so this is just a normal market process of revaluing based on current market conditions, which have changed dramatically. So I think you should look at these numbers as good news that the market is getting to a place where it is more fairly valued,
Yeah.
and can start leading the way as soon as the economy is through some of the morass.
Yeah, exactly.
So that's the good news on the stocks. The other good news we have to keep in mind is on the bonds. Okay, so this is a Schwab, it was called it kind of a yield curve, kind of shows, like US Treasuries, again, that 1 year, this is from Monday, was paying 4.8. Now I checked today because bonds have done well. It's now 4.6. But you're going to start making money on the bonds. And again, it might take a little while for them to fully recover, but I do think it's set for a recovery.
Right. And just to hit this a little bit finer, we're talking about US Treasuries here, which is considered the safest investment around. So there's no real threat of default. They're going to pay their interest payments on time. And when when the bond matures, you're going to get your money. So this is like the safest area of investment markets there are. And your short-term money is earning nearly 5%. And we've included this in our client portfolios, and in some of the bond funds we have. We've been focusing on this area a lot just for safety and for cover. So right now that area looks kind of nice because even if nothing happens, we're going to get a nice interest rate. And if the Fed gets what they want, that is a recession, they're going to combat a recession with lower interest rates. And when lower interest rates go down, even though we're losing less interest, the price of the bonds go up. So it's a nice position to have right now where you're kind of getting paid for just holding on to bonds. And if we do get this recession that the Fed wants, we can see the price of those bonds increase and gain some value there as well. I think is this our last slide, Mark?
This is our last slide, and Dan, I think we did such a phenomenal job. There's no questions.
Yes.
But my gut's telling me that I've screwed up the technology again, and so I can't see the questions. But anyway, yeah.
I have them up. I don't see any questions here in the chat room, in the chat areas, or in the Q&A areas. But I guess if you want to leave on one last little thing, and I'm going to call this perspective. And if Mark, you can turn this off. I don't have a chart for this or anything. I'll just talk through it a little bit. I've been talking to clients here lately about, people have been nervous about the volatility and how long it's been going on. Is the market's ever going to turn around? I don't know. And I said this a little bit earlier that, we have to go back pretty far in time where we've had, 10 months, 11 months of volatility like this. I mean, it's back to the financial crisis. But just kind of give it some perspective right now. So this is as of this morning. The S&P down, I said this earlier, the S&P 500 is down 20.28% year to date. International stocks are down 20.23% year to date. The bond markets were down 15.77% year to date. Just kind of give it a little bit of perspective. From the COVID high where the S&P 500 had peaked to its low, when COVID hit back in February 2022 to about mid-March, the next month, March 25th, something like that. That market, the S&P 500, was down 33%. The international stocks were down 32 to 33%, depending on the peak, where you look at the peak there. Now, this is where we kind of diverge, but bonds were only down 1% during that period. So just kind of looking back, the market really did way worse in COVID from where we are right now. I'm not saying the market won't go down that far, but we could see some further down. But, comparatively, it's not as bad as it was then, and that market recovered, and we did very nicely for the following year and a half. Maybe almost 2 years of that period. So just to kind of give us some perspective on that. Markets aren't as down as bad as they were during COVID, and we haven't had a prolonged down volatility in a very long time. So our memory tends to play with us during these time periods where we kind of forget how bad things were, even as recently as a couple of years ago, and certainly, you know, how bad they were 14 years ago. That makes sense? Did I leave that on a downturn? I tried not to leave it on a downer. I try to leave that for you.
That makes sense. So I think what to look for in the months to come is, as Dan said, there's still gonna be a lot of volatility up and down.
Mhm.
There's going to be lots of news that comes out that moves markets. It's not going to be a linear straight up or straight down. It's just going to be kind of like a sawtooth kind of motion. And we're doing the best we can to rebalance and buy more into those down markets,
Right.
and then sell into some of the up markets. And then, as we've mentioned before, we're doing a lot of that tax loss harvesting to try to that will be very useful in helping clients pay less taxes in the future. So onward and upward, I guess. So we'll have to see what the market does tomorrow.
Yes.
Certainly the next week with the election numbers coming out will certainly be interesting. Everybody, you know, who's listening or who listens on the recording, if you have questions or want to talk about this in more detail, feel free to reach out to Dan or I or your advisor, and we'll continue to as long as you guys like this format, we'll continue to be doing these, say, quarterly and
at least semi-annually or what have you.
Yeah.
Hey, well, there is one question here I do see, and then we can answer this real quickly, I think. And so client's asking, would you recommend using any extra cash in our bank account to purchase one-year treasury bonds? I would say basically, yeah, if you don't have any plans for that cash and don't mind tying it up for, it's not really tied up. It's not like you can't sell it or anything. Yeah, I would say if you want to earn a little bit more, we can buy some treasuries or buy treasuries with it. You can even consider buying CDs. CD rates are nearly as high. The only issue with CDs is that you can be locked in with that rate. And if you wanted to get out for whatever reason, like you had an expenditure that you needed that cash for, you could be penalized for it. Or the penalty with buying a treasury is that, you know, the price does fluctuate a little bit. And so you could be buying it at an inopportune time. But yeah, if you have extra cash, you don't have use for. Yeah,
I agree. We have been buying treasuries for clients, and but excess cash, again, you can see this is just the 1-year treasury. You can get a 6-month treasury for 4.6. And what's
crazy.
You know, people may or may not know is U.S. Treasuries, you pay federal tax, but you don't pay state tax. So if you're in California or New York or places with high state taxes, you can see this is more attractive than an equivalent CD.
Yeah,
and they're both guaranteed, backed by the government. So absolutely.
Yeah. Oh, thank you for that question. It's a great question. All right, that's it.
Okay, thank you all.
Thank you for attending, and please give us some feedback. Leave us a message and an email. Even if it's bad news that we really suck at this, that's okay too. We want to hear that too.
Yeah, and I think we're going to send a survey out. So please, if you have comments, negative or positive, let us know so we can keep improving this.
All right. Thank you, everybody.
Thank
Have a
you.
good day.
Okay, bye-bye.